What psychological biases sabotage your financial decisions? Imagine making financial choices that seem right at the moment but end up costing you in the long run. Many adults face hidden mental traps that influence their investment plans without realizing it. These biases can steer you away from logical decisions and toward behaviors that hurt your financial growth. Understanding these biases is key to better personal financial planning and core financial planning. One common bias is overconfidence. People often believe they know more than they do about market trends. This can lead to excessive trading, ignoring risks, or not diversifying investments properly. Overconfidence might make you think you can beat the market, but it often results in bigger losses. Then there's confirmation bias. This happens when you seek out information that supports your existing beliefs and ignore facts that challenge them. For example, if you believe a stock will rise, you might only notice positive news about it, even if the market signals are negative. This can cause you to hold onto poor investments longer than you should. Anchoring bias is another trap. It occurs when you fixate on an initial piece of information, like the price you paid for a stock, and refuse to update your view based on new data. If you bought a stock at $50, you might hold onto it even if its current value drops to $30, just because of that original price. This can make you hold onto losing investments or sell winners too early. Loss aversion is a strong bias too. It makes you feel the pain of losses more than the joy of gains. So, you might hold onto a losing investment to avoid realizing a loss or sell a winning one too soon to lock in gains. Both behaviors can hurt your long-term growth. Hurting behavior is when you follow what most people are doing, even if it's not the best choice for you. Buying at market peaks or selling during downturns often happens because of this. It can cause big losses, especially if you act emotionally rather than logically. Mental accounting is when you treat different amounts of money differently based on where they came from or what you plan to do with them. This can lead to poor asset allocation because you might keep separate funds for specific goals but neglect the overall health of your portfolio. Recency bias is when recent events influence your decisions more than long-term trends. If the stock market has been doing well lately, you might invest more heavily without considering the bigger picture. Conversely, if recent downturns scare you, you might sell too quickly. To improve your financial planning, it's important to set a disciplined, long-term strategy based on data, not emotions. Working with financial professionals can help you stay objective. Regularly reviewing and rebalancing your investments can also prevent biases from taking over. Being aware of these biases helps you recognize when your feelings or shortcuts are guiding your choices. This awareness can lead to smarter decisions, better investment outcomes, and a more secure financial future.